Now let's talk about consideration of fraud in a financial statement audit, AUC 240 again. Now here's the deal. With consideration, we're looking at the different steps in going through and kind of looking to see how to analyze fraud, see if it exists, and so on. So it says here, first of all, understand the nature and characteristics of fraud. Now, what does that mean? Understanding the fraud risk triangle. What is it? The motivation, which is incentive and pressure. The opportunity, rationalization. Also understanding the types of fraud, fraudulent financial reporting, misappropriation of assets. That's what I mean by understanding the nature and the characteristics of fraud. Then hold a brainstorming session. Now that's important because that's something we do here under PCAOB and AICPA. We do not necessarily do this international, which we'll talk about the similarities and differences in another section. It says here, hold a brainstorming session with engagement staff to discuss the risks of material misstatements due to fraud. How and where financial statements might be susceptible to fraud, how management could perpetrate and conceal. Now that's important, highlight that. Perpetrate and conceal. How could we perpetrate? How do we commit a fraud and then hide the fraud? That's what we're concerned with. Because if you commit the fraud and then hide the fraud, we're not going to catch it. So we want to make sure that there is a good segregation of ARCs, authorization, recording, custody, comparison, that different people are doing all these things. That way, if it does occur, there's a higher probability that we will detect it. So preventing it means keeping it from happening. Detecting it means it did happen, but at least you'll find it. Consider known internal and external factors affecting incentives and pressure, motivation for fraud, opportunities, and rationalization. That's our fraud risk triangle. And exercise professional skepticism. So that's a brainstorming session. Obtain information needed to identify risks of material misstatement due to fraud. So we're going to ask questions, do analytical procedures, consider the fraud risk factors, which we're going to talk about shortly, and consider other information like unpredictable tests. Remember I said you don't want to tell them ahead of time what we're doing. Identify the risks that may result in a material misstatement. So what that says is we want to also look at, for example, identify risks. So it says whether the type of risk indicates misappropriation of assets or fraudulent financial reporting, whether the risk is of sufficient magnitude, the likelihood that the risk will result in a material misstatement. So we have to apply professional judgment in looking at those elements. Evaluate those risks, taking into account the entity's internal controls. Determine the nature, time, and extent of substantive procedures needed to respond. Evaluate the audit evidence obtained. So it says evaluate accumulated results of procedures at or near the date of the auditor's report. Consider if identified misstatements may be indicative of fraud. Communicate. Now with communication, we want to communicate at least one level above where it occurred. One level above, not below, but above. It says any evidence of the existence of fraud should be communicated to management. Fraud involving senior management and fraud resulting in a material misstatement should be communicated to those responsible for governance. You also have to decide whether or not you want to keep the job or withdraw. Right? And then maybe also talk to your attorney. And then document the consideration of fraud, which includes the brainstorming session, procedures performed, identified risks, reasons revenue recognition was not considered a fraud risk factor if appropriate, results of procedures performed in response to risks of management override, other factors drawing the auditor to the conclusion that additional procedures were required, and finally the nature of communication about fraud. So all of that, those are basically the steps in considering fraud. Now, I mentioned something called fraud risk factors. And you'll see here two different charts. And these two different charts talk about the fraud risk factors. I've broken them down into the following way. I've broken them down between motivation, opportunity, rationalization. And both charts broken them down between fraudulent financial reporting and misappropriation of assets. So the first one talks about fraudulent financial reporting. That is where, as a whole, they're fraudulently reporting the financial information. Then you'll see the three columns which deal with incentive, pressure, motivation, the opportunity, and finally, rationalization. This gets tested in multiple choice. This gets tested as a task-based simulation. This does show up quite frequently. These charts are worth looking at. And these come right out of the standards. All right, the first one, highlight fraudulent financial reporting. That is this. Okay, it says motivation, incentive, or pressure. Threats to financial stability or profitability. It says decline in margins along with a high degree of competition or sales saturation. So what is the incentive or pressure? The incentive or pressure is there's a decline in your margins or there's a lot of competition. So your market, your industry is suffering. High vulnerability to rapid changes. Declines in customer demand, threat of bankruptcy, recurring negative cash flows, rapid growth or unusual profitability, new accounting, statutory or regulatory requirements. All of these are things that are motivation, either pressure as to why you might commit fraudulent financial reporting. Pressure to meet requirements or expectations of third parties. So as I mentioned earlier, for example, analysts' expectations. Creditors, or there you go, analysts, have profitability or trend expectations, particularly if aggressive. Need for additional debt. So you need more money, so we're going to try to make the numbers look better. Difficulty in meeting exchange listing requirements or debt covenants. A covenant is restrictions. Potential adverse effects of poor financial results on pending transactions. Threats to personal financial situations or of management or directors. Significant financial interests, compensation largely contingent on financial results. That's a big one. If your bonus is based on profitability, what are you more likely to do? Manipulate the numbers. We're going to talk a lot about this in corporate governance, which is in the BEC exam, and you'll see there's a lot. We talk about internal control and COSO, comprehensive organization, sponsor organization, and all this good. So there's a lot of overlap. And as I teach you one part and another, as we teach you all the different parts, it all starts to come together, and you start to see how auditing ties into FAR, ties into regulation, and so on, BEC. So there's a lot of overlap. Personal guarantees. Number 4, excessive pressure by management or governance to meet financial targets. Opportunities. Why do the opportunities? Bad internal control. Significant related party transactions. Entity has ability to dictate terms or conditions. Now that's a biggie. You'll see that in the homework where they dictate to the companies. That means they have too much control or power. That's a problem. Accounts based on significant estimates. Significant, unusual, or highly complex transactions, especially near period end. Significant international operations. Significant bank accounts or operations in tax haven jurisdictions. Management not monitored. Management dominated by a single person. Highlight that. Ineffective oversight by governance. Organizational structure. Difficulty in determining organization or individuals with controlling interests. High turnover of senior management. You know, this is the third controller in a month. That's a problem. Deficiencies in internal control, inadequate monitoring, ineffective accounting. Accounting and information systems are not effective. Attitudes that this is an attitude of rationalization. Ethical standards not effectively communicated. Non-financial management inappropriately participate in selecting accounting principles. History of violations of securities or other laws. Aggressive or unrealistic forecasts. Management fails to correct significant deficiencies on a timely basis. Management's interested in minimizing earnings for tax reasons. So again, all of these are what? Fraudulent financial reporting. They're called fraud risk factors. You will see these in the class questions and in the homework. Examples of fraud risk factors. This deals with what? Misappropriation of assets, which is this. So now we're going to go through these 3 again for misappropriation of assets. Pressure, so incentive, pressure, motivation. Pressure created by personal financial obligations of management or employees. So in other words, you've got a lot of personal debt. You've got an employee making $10 an hour driving a brand new Ferrari. Could be a problem. Think so? Maybe. Adverse relationships between the entity and employees. So in other words, they're all angry at the boss. They have access to assets, known or anticipated layoffs, changes to compensation or benefit plans, promotions. You know, you cut people's salary. You have cutbacks. You have a furlough where you take 1 day off a month so they're getting less money. You cut their benefits. You cut their retirements. You cut all these things. People go, I'm going to make it up by stealing. Opportunities, assets particularly susceptible due to characteristics or circumstances, large amount of cash on hand. Remember, cash, inherent risk. Inventories consisting of small, high value, high demand items. That's inherent risk. Assets easily convertible, such as bearer bonds, diamonds, fixed assets that are small. That's why, again, inherent risk. Inadequate internal controls, segregation of duties, monitoring of employees with access to assets, record keeping for assets, and so on. So these are all, again, opportunities. Attitudes to rationalize deals with what? Disregard for need for monitoring or reducing risks, disregard for internal control, behavior indicating displeasure or dissatisfaction with the company or its treatment of employees, changes in behavior or lifestyle indicate assets may have been misappropriated. So again, remember these charts, and it talks about fraud risk factors. So you'll see the terms fraud risk factors. You will also see them for both types of fraud, which is what? Fraudulent financial reporting. That's fraudulently reporting the financial information at a high level versus misappropriation of assets, could be at any level. Again, that's important to understand as far as consideration of fraud in the financial statements.